Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. This video is the continuation of the last video AS11, Accounting Standard 11, on accounting for effects of changes in foreign exchange rates. So many organizations have foreign transactions. So they have to convert the foreign currency into the reporting currency. So the rules regarding how to convert the foreign currency into home currency or reporting currency, the provisions are contained in AS11. So last video I have explained you about the introduction of this accounting standard AS11. That means what is the scope? The accounting standard 11 is applicable for those transactions, accounting for those transactions which are concerned with foreign currencies. And we have to convert it into reporting currency or home currency. Secondly, financial statements of foreign operations should be translated into reporting currency. Lastly, forward contracts in currencies. So these are this is the scope of this accounting standard 11, AS11. So last video I have explained you about this introduction. I have explained you about the definitions which are used in this AS11, like foreign exchange or foreign exchange rate difference, like these monetary items, non-monetary items, integral foreign operations, non-integral foreign operations. All these things I have already explained in the last video. Lastly, I have explained you this AS11 prescribes the accounting treatment for foreign transactions at initial stage, initial recognition, then balance sheet valuation at balance sheet date, and then contingent liabilities and the treatment of exchange rate difference. These are the four effects of this AS11. In the last video, I have explained you about initial recognition. Remaining 3 points I am going to explain in this video. So this is the last video on AS11. So before starting the explanation of this topic, take the screenshot of the points which I have written on the board, then I'll explain all the points in detail. Now, see, AS11, Accounting Standard 11. The topic is accounting for effects of changes in foreign exchange rates. The foreign exchange rate is the rate at which one currency is changed into another currency. Example, the Indian rupees. How many units of Indian rupees is equal to 1 unit of foreign currency like dollar? So we can say 81.5. So presently, 81 rupee 50 paisa of Indian currency will be equal to $1, 1 US dollar. That is called exchange rate. And this exchange rate will fluctuate from time to time. So due to this, the financial statements of the organizations which deals in foreign trade, foreign transactions will get affected. So this accounting standard is concerned only on those organizations which have foreign transactions, right? Now, for this purpose, first of all, there are four aspects I told you: initial recognition, then valuation at balance sheet date, contingent liability, and a treatment of exchange rate difference. So already initial recognition I explained you in the last video. In this video, valuation at balance sheet date. At the balance sheet date, we have to value a number of assets, a number of liabilities. So how to find out the value of those assets and liabilities as on the balance sheet date? That provision is given by this AS11. So for this purpose, all foreign currency denominated transactions are classified into monetary items and non-monetary items. That means as on the balance sheet date, we have to convert the foreign currency into reporting currency. For converting the foreign currency into reporting currency, all the transactions, all the items can be classified into monetary and non-monetary. First, monetary items. Before explaining the provision for monetary items, we must know what is the meaning of the term monetary items. Monetary items are money held and assets and liabilities to be received or paid in fixed or determinate amount of currency. That means those items of assets or liabilities which have a fixed or determinate amount of currency. For example, specific amount of currency. The business has to receive $10,000. Specifically, amount is clearly mentioned. $10,000 is to be received or $10,000 to be paid. The amount is fixed. So whenever for an amount, asset or liability, when the amount is fixed, it is not going to be changed. That item will be called as monetary item. In other words, their value is fixed in money terms and it does not increase or decrease because already there is a contractual agreement, how much amount to be received, how much amount to be paid. So no change in the amount. So examples of monetary items are cash in hand, cash at bank, trade receivable, trade payable. So remember, these items will have a fixed money value. So these fixed money values are called monetary items. Second one, non-monetary items. Any item which is not a monetary item will be treated as non-monetary item. That means the value will get changed. The value will not remain same. So non-monetary items are assets and liability other than monetary. So they are recorded at their historical cost or at fair value as their value might keep changing. The value of those items will keep changing. So these items will be recorded at their historical cost or their fair value. So we must know what are the items that will come under non-monetary value. Here, for example, property, plant, equipment, inventories, etc. are non-monetary values. Property like non-current assets, plant, equipment, building, furniture, inventories. The value of these assets or items will go on changing. Go on changing due to the exchange rate difference. So these items are called non-monetary items. Now, how to value the monetary items and non-monetary items? That is important. That is the crux of this accounting standard. So as per AS 11, monetary items should be reported at the closing rate. That is the exchange rate at the balance sheet date. One point, very important point, this one. You have to remember this, and in examination you have to write how the monetary items will be reported. The monetary items will be reported at the exchange rate of the balance sheet date. Suppose the balance sheet is prepared on 31st March 2021. So as on 31st March 2021, what is the exchange rate? At that exchange rate, monetary items will be valued. That point to remember. Secondly, AS 11 specifies that non-monetary items that are carried at their historical cost must be converted using the same rate that was used at the time of initial recognition. Simply, non-monetary items should be translated at that rate at which it was initially recognized. When the first time it was recognized, at that time whatever was the exchange rate, same exchange rate will be applied for non-monetary items. Example, we are preparing the balance sheet on 31st March 2021. So at the time of making the balance sheet, we have to segregate first of all monetary, non-monetary items. Monetary items will be valued at the closing rate. That means the rate on balance sheet date for monetary items. For non-monetary items, we have to see what is the initial recognition rate. When we recognize that asset or liability, so what was the initial rate? That rate only will be used, not the balance sheet date. Not the rate of balance sheet date. That is for non-monetary items. That's all. So we have explained about valuation at balance sheet. Next is contingent liabilities. Contingent liabilities means those liability which depends on some conditions. The liability may occur or may not occur depending on some event. or condition. So how to calculate the value of that conditional liability? Again, AS11 says, take the rate on the balance sheet date, closing rate. Whatever the exchange rate on the closing of the balance sheet date, that exchange rate will be applied for contingent liabilities. Now, last one, treatment of exchange rate difference. Exchange, ERD, commonly it is called ERD, exchange rate difference. So, the difference, the exchange rate may differ. For example, at the time of entering the transaction, the exchange rate was 80 rupees per dollar. At the time of closing the accounts on balance sheet date, the exchange rate is 82 per dollar. So there is difference. At the time of transaction, 80 rupees. At the time of balance sheet preparation, 82 rupees. So there is difference in the exchange rate. How to treat the difference in exchange rate? AS11 has specified. So ERD, exchange rate difference arises when a transaction is. So when the exchange rate difference will arise? First one, reported at a rate that is different from the rate at which it was initially recorded. That means any transaction which was recorded earlier, at the time of entering the transaction, the rate was different. At the time of closing the balance sheet, the rate is different. So this will give you ERD, exchange rate difference. Secondly, on settlement of a monetary or non-monetary items at a rate different from the rate at which it was initially recorded. Settling the transaction. For example, accounts payable, trade payable. So we are paying the amount at a later date, but the transaction was occurred at an earlier date. So there may be difference between the transaction date and the settlement date. So again, ERD will arise, exchange rate difference will arise. Settled at a rate different from the one taken from reporting in the last financial statements. Some items are there which are in the last financial statements. And current year we are settling those transactions. Again, the rate will be different from the last balance sheet, last financial statements to the settlement date. So these are the events where ERD will arise, exchange rate difference will arise. Now how to treat this ERD? AS11 has given, and all ERD are charged to profit and loss account of the period. So this ERD may give gain or may incur loss. Sometimes due to exchange rate difference, the firm will get the gain, and sometimes the firm will incur loss on exchange rate difference. So this gain or loss should be charged to profit and loss account of the concerned period. That is the provision given by AS11. Now, two concepts are there. That is foreign currency translation reserve, that is called FCTR. In examination, very frequently they will ask you to explain FCTR, foreign currency translation reserve. So here I am going to explain you what is this FCTR. So when an entity has a foreign branch and the operations of the foreign branch is treated as non-integral foreign operations, then ERD arising on a monetary item should be accumulated in FCTR till disposal of net investment in non-integral foreign operation. First of all, when a firm is having foreign operations and those foreign operations are non-integral operations, then any ERD arising, any ERD exchange rate difference arising on those non-integral operations, that ERD will be transferred to FCTR, foreign currency translation reserve, till the net investment in that integral operations. Till the time of net investment in that operation, till that time it will be kept. So on disposal, the balance in FCTR should be recognized as an income or expense in the statement of profit and loss. When the transaction is settled, when the disposal of that net investment, there is a balance in FCTR. That balance may show sometimes gain or loss. So balance in FCTR should be transferred to profit and loss statement at the time of disposal. Till the time it is not disposed of, this will be shown as balance in FCTR, foreign currency translation reserve. So remember, if a firm is having foreign operations and those foreign operations are non-integral foreign operations, then whatever ERD arises, exchange rate difference, that will be kept in this reserve. The net investment in this operations will be kept in FCTR. On disposal, the balance will be transferred to profit and loss statement. That is FCTR. One more account is there, FCMITDA. What is the full form? Foreign currency monetary item translation difference account. Again, it will be asked in theory question regarding explain FCMITDA. So this is a foreign currency monetary item translation difference account. If the entity has exercised the option to capitalize the ERD, that means the AS11 says it is up to the decision of the management whether to treat, capitalize the ERD or treat it as revenue. Some firms will make a policy of capitalizing the ERD, exchange rate difference. Then if the firm has decided to capitalize the ERD, then they have to maintain this FCMITDA. So if the entity has exercised the option to capitalize the ERD on long-term foreign monetary item, then only they have to maintain this FCMITDA, right? Only when the firm has made a policy to transfer, to capitalize the ERD. Now disclosure. Finally, we will, I'll explain you about the disclosure as per the AS11. What are the disclosure provisions? First one, an enterprise should disclose amount of ERD included in the profit and loss account. First of all, AS11 says every firm which is having foreign transactions must disclose the ERD, exchange rate difference, in the profit and loss account. Secondly, net exchange difference accumulated in FCTR, foreign currency translation reserve. How much amount is transferred to FCTR, that should be disclosed. Thirdly, reconciliation of opening and closing balance of FCTR. Already existing FCTR is there. How much is the difference between opening and closing balance of FCTR? Then reconciliation of opening, amount remaining unamortized in the FCMITDA if the reporting entity has chosen to capitalize ERD. If the reporting entity has decided to capitalize ERD, then remaining amount, how much is the remaining amount in FCMITDA, foreign currency monetary item translation difference account. If the reporting currency is different from the currency of country of the reporting enterprise, the reason for the same. The currency difference. Why this currency difference is arising? What type of transactions this reporting, currency is being conducted with foreign currency? A change in classification of significant operations need to the following disclosure. When the foreign operations are there, so the reason for foreign operations should be disclosed. Example, nature of change in classification, reason for change, effect of such change, shareholders' funds, impact of such changes on the net profit or loss, and foreign currency risk management policy. So these are the items to be disclosed in the financial statements according to AS11. Now points to be noted. Some points to be noted by those firms which have foreign currency transactions. First point, whenever a transaction happens, it is recorded by applying the rate at the time of the transaction. First of all, the transaction should be recorded at the rate of initial recognition. That means whenever a transaction takes place, on that date, what is the exchange rate? That rate will be used for recording the transaction. Secondly, on each balance sheet date, monetary items are reported at closing date. Just now I have explained you. We have to divide into two categories: monetary items, non-monetary items. Monetary items should be recorded at the closing rate, means the rate of the balance sheet date, whereas non-monetary items are reported at their historical cost. At the time of entering the transaction, whatever was the exchange rate, that rate will be used for non-monetary items. Then if non-monetary item is reported fair value, then the rate applicable in balance sheet date is applied. Sometimes the non-monetary item is valued not at historical cost but at the fair value. If the non-monetary item is valued at fair value, then we have to use the closing balance sheet date rate. All ERD are charged to P&L account except in case of FCTR and FCMITDA. All the exchange rate difference, whether it is gain or loss, should be taken in profit and loss account except two. In two cases, the exchange rate difference should not be taken. Those two cases are FCTR and FCMITDA. In these two cases, it should not be charged to profit and loss account. Then FCTR is created when an entity has foreign branch and its operations are treated as integral. Just now I told you, FCTR, this account will be maintained only when a business is having foreign operations and those foreign operations are non-integral foreign operations. And FCMITDA is created if an entity opts to capitalize the rate difference. If the business decides to capitalize the ERD, then only this account is maintained, FCMITDA. The balance in FCMITDA is shown under reserves and surplus. So, at the time of disposal, after disposal, whatever balance is there, that will be transferred to profit and loss account. But if it is not, the disposal is not yet conducted, then whatever balance is there in FCMITDA, that balance will be shown under reserves and surplus. Now, translation of financial statements. When a business is having foreign operations, the financial statement of foreign operations should be translated at the reporting currency. So, what are the rules for translating the financial statements of foreign operations? Here AS11 has given integral operations. If the operations are integral operations, then all fixed assets should be recorded at historical cost and all monetary items at the closing rate. Monetary items should be translated at the closing rate, whereas non-monetary items should be translated at historical cost. All transaction, purchase, sale, operating expenses at average rate. All the day-to-day operating transactions, should be, translated at the average rate. Then opening balances should be translated at the opening rate. Then non-integral operations, all transactions rate on the date of transaction or average rate. All assets and liabilities at closing rate. So these are the rules to be applied for translating the financial statement from foreign operations into the reporting currency. Last one is forward contracts. Forward contract is a contract which is agreed now, but it will be settled on a future date. So for forward contract, hedgers, forward premium or discount is amortized over the term of the contract. ERD is taken to profit and loss account. So these are the provisions applied by AS11 for accounting for changes in the foreign exchange rates. So these two videos are enough for remembering the provisions of AS11. Inshallah, the next accounting standard AS12 we will continue in the next video.